Third, it may very well be that any given industry that provides essential goods and services has plenty of competition, but still exorbitant prices due to practical limitations. In this case, I recommend government funding of research into ways to provide the most basal raw materials more cheaply, and government funding of the development of alternatives. Indeed, I recommend maintaining this third step under all circumstances. The more cheaply the most essential goods and services can be provided, after all, the greater the percentage of the population who can live above the poverty line. Not necessarily in luxury, but at least out of poverty. The second and third of these steps should lower cost, allowing suppliers to boost supply, thus lowering prices. The idea is that competition over customers is supposed to make the most of quality and the least of price, but it seems to me that competition can only be expected to have this effect in industries that rely heavily on repeat business. In such a case, the company has to worry about its reputation. Such is not the case in the health insurance industry. So-called health insurance providers don't profit from providing health insurance. They profit from finding excuses to deny it. They profit from offering it enough to keep you paying in on it, but then finding excuses to avoid paying out on it themselves. Revenue is the term which refers to money that comes into an organization in a certain period of time. Expense is the term which refers to the money that goes out in a certain period of time. Profit is what is left over after expenses are subtracted from revenue. So if an organization wants to make the most of its profits, its bottom line, then it has a vested interest in continuously seeking out ways to increase revenue and decrease expense. A health insurance company's main source of revenue is the premiums being paid by its customers. To increase this, it has to either gain more customers, increase the premiums its existing customers are paying, or some combination of the two. A health insurance company's main source of expense is the claims it has to approve. To decrease this, it has to find every available excuse to decline every given claim, even with death on the line. So no, health insurance coverage is not maximized by private competition. But something that really causes me concern is the relationship between creditors, debtors, and inflation, and how little the general public understands this relationship. Of course, I must now explain these concepts, but I'll be glad to. A loan is basically a kind of agreement between two parties. One lends money to the other with the understanding that the other will pay it back at some future point. Most likely, every person watching this video has had occasion to lend money to someone or borrow money from someone, so we all know what a loan is. The party who lends the money is called a lender or creditor, and the party it is lent to is called a borrower or debtor. Common is the question, if we're going through a financial crisis, why doesn't the government just print more money? The answer is that a financial crisis is not due to a shortage of money, but a shortage of purchasing power, and an increase in one does not necessarily yield an increase in the other. There's the question of how much money a party has, and the question of how much that party is worth. Let's say that you work full-time at $10 an hour, and there's something you want to buy that costs $40. That something is worth 4 hours of work. But what if instead you worked full-time at $11 an hour, and the thing you wanted to buy cost $44? That something is still worth 4 hours of work. You would be getting more money in the second case, but your purchasing power would be the same. So think about it. Imagine if I gave you a choice. With option A, your income, your personal revenue, doubles, and everything else remains the same. You have the same working conditions and hours, and all the things you buy to maintain your standard of living remain the same price. With option B, on the other hand, the price of all the goods and services you rely on in your day-to-day existence, your personal expense, cuts in half, but nothing else changes. Which is better? Well, the truth is neither is better. Only one of these options increases your money supply, but both increase your purchasing power. The first option means that your supply of monetary units increases and each goes just as far as before. The second means that your supply of monetary units remains the same, but each individual unit goes further. Think of a single party's purchasing power as a ratio of revenue to expense. Not the difference, the ratio. The higher that ratio, the greater your purchasing power. So if we take your current situation and double your revenues and keep your expenses the same, or if on the other hand we take your current situation, keep your revenues the same, and cut your expenses in half, in either case the effect is the same. Only the first case doubles your money supply, but both double your purchasing power. So if the government just prints more money without making any other changes, this keeps the overall purchasing power of the nation constant, but breaks it up into more pieces, reducing the value of each piece, each monetary unit, each dollar. There we have inflation. Now let me just pause here to explain a key three-way contrast. Inflation is what it's called when you have the overall cost of living increasing, reducing the value of each individual monetary unit. So when this cost decreases, it's called deflation. There's also the occasional phenomenon when it increases during a certain period of time, but by less than it increased during the previous period of the same duration. This is called disinflation. Now what does any of this have to do with creditors and debtors? Well, observe that debt is measured in currency, not purchasing power. It may accumulate interest, but it's not adjusted for inflation unless that is specified in the contract. A $500 debt is less significant after a year of inflation. So parties who owe money have a vested interest in putting pressure on the government to print more money in order to cause inflation to the end of devaluing their debt. True, parties who lend money and to whom money is owed have a vested interest in putting pressure on the government not to. But what happens when debtors wield more political clout than creditors? Now what about bonds? These cause me real concern. A bond, essentially, is a debt with a repayment time agreed upon in advance. When you buy a bond, you're buying debt. The money you put into buying the bond is essentially a loan to the organization that issued the bond with the understanding that it will be paid back at a predetermined date, which is called the maturity date. The period between when the bond is bought and when its payment is due is called the maturity period. Well, what if it's a corporate bond? That is, what if the bond issuer is a corporation? Suddenly that corporation, being a debtor, has a vested interest in putting pressure on the government to print more money in order to encourage inflation to the end of devaluing its debt to you, taking value away from your bond. What if the corporation is a fairly large one? Well, then it's able to put quite a lot of pressure on the government to this end. What if, on the other hand, it's a government bond? That is, what if the bond issuer is the government itself? That means that the government itself has a vested interest in printing more money in order to encourage inflation to the end of devaluing its debt to you. You may well disapprove of the practice of putting pressure on the government to print more money just to devalue your debt, and I would join you in that, but since the motive and the opportunity exist, we can expect this to happen no matter how we may disapprove. You may well disagree, but I say that since saving money is a good thing, inflation is a bad thing. We are all encouraged not to bother saving money if we know it will lose value while in savings. What if your savings account pays 1% interest annually, but inflation increases by 3% annually? That means that although the amount of money in your account, if left undisturbed for a year, has increased in amount, it has actually decreased in value. Your $100 has increased to $101, but is worth what $97.97 was worth before, and that's before taxes. Therefore, we have a vested interest as a society in both taking steps to counter this pressure and taking steps to limit the need for debt.